The big mistake right now is trying to guess where rates are going because apparently even the Bank of Canada isn't sure. Let's break down what they said in this latest meeting and what it actually means for you. Hi, Becky here, independent mortgage broker for 20 years. Let's translate the Bank of Canada lingo so you can make better decisions. Up first is the headline. Bank of Canada did not change rates. They held their rate at 2.25%. That part was not surprising. What's interesting is why they held and what they said next. So here's the simple version. The world is a mess right now. Oil prices have jumped, and that's pushing inflation back up. That's it. That's the story. This is straight from the bank's report. They're basically seeing oil prices jump because of the war, and that's making everything more uncertain. Everything gets more expensive when oil goes up. Gas, shipping, food, flights, basically your entire life, and that pushes inflation up. We are watching this in real time. Inflation jumped to 2.4% in March and is expected to hit 3% in the short term. This chart shows inflation starting to move back up, mostly because of gas prices. The bank is basically saying, we think this is temporary. Wait, where have I heard that before? Let's see. Oh, yeah, I remember 2021 when they said inflation was transitory. They're expecting oil prices to come back down and inflation to fall back to 2% next year. I think that's very optimistic. Now, what happens if inflation does not come back down and oil prices do not come back down? They will raise rates. So now let's bring this back home. Canada's economy is not terrible, but it's not strong either. Growth is slow, jobs are soft, housing is weak, and people are stretched. Unemployment is sitting between 6.5% and 7%. You can actually see here the job market is soft, hiring has slowed down. This is tied to where the Bank of Canada has rates sitting right now. Okay, so here's where everything gets really interesting. Canada is an oil country. So when oil prices go up, it actually helps our overall economy, but it hurts people personally. So the country makes more money, but you feel that pinch. That's the tension right now. Now, here's what the markets are saying. They've basically gone from rates are going down to wait, we might get rate hikes again. Bond yields are climbing, and this matters because fixed mortgage rates follow bond yields. So even though the bank didn't raise rates, fixed mortgage rates can still move higher. Okay, the bank gave us two paths. Scenario one is the best case scenario, and that's oil settling down, inflation cooling, and rates staying about the same. Scenario two is the riskier scenario where oil stays high, inflation spreads, and rates go up again. They were very clear. They will not let inflation get out of control again. That is Bank of Canada talk saying we will raise the rates if inflation gets too high. So, what does this all actually mean for you? Here's the honest takeaway. Rate cuts are out the door. Fixed rates are drifting higher and uncertainty is back. I have said uncertainty more in the last year than in my entire life. So this is why I say stop trying to guess rates. Choose a mortgage that fits your life, your financial goals, and the goals that you have for your property. Because the wrong mortgage in the wrong environment can cost you more than a higher upfront rate.